Well, the nation's largest banks have reported quarterly earnings, and there were bright spots in investment banking, and particularly in trading, as we saw with Morgan Stanley. But my next guest worries that banks and fund managers have not learned their lessons over the last 2 years. And Leo Tillman was head of institutional strategy at Bear Stearns and now has his own advisory firm. And Leo, good morning. Great to have you back in the studio with us. Generally, though, with these earnings, from what you've seen, and we've seen some stellar results coming out from Goldman, from J.P. Morgan, and Morgan Stanley was doing pretty well. What did they highlight for you?
Well, we knew for a while that this is an ideal time for financial industry, provided that they came into this crisis with good balance sheets. You have great bid-ask spreads, underwriting fees, you name it, every source of revenue is at record highs because of the financial crisis. And that's why you're starting to get a sense that it's business as usual, and people are going back into doing exactly what they used to do. And once this environment subsides, I think this is going to create the same kind of earnings pressures and competition that set up the previous crisis.
So you're saying it's great right now, but it's great in an abnormal environment.
Exactly. Exactly. The environment is particularly conducive to these kinds of businesses. We're seeing record earnings coming from those departments. But what comes next is and how these companies respond to the compression of these margins, which is inevitably will follow, is a big question. And unless they learn the right kind of risk management lessons, it's going to be pretty much a repeat of what we saw in the past couple of years.
And Leo, what area first? Right now, a lot of people are talking about M&A, for example, that you're going to see a lot of merger and acquisition activity over the next few months. So that would suggest you're going to continue to see benefits for the investment banks from that perspective.
Yes, I think M&A and advisory will continue to be strong. Trading revenues in both fixed income and equities are going to be strong. So these areas should continue benefiting from the current environment, as will the commercial banking arms, just because of the shape of the yield curve. So we should continue seeing strong results. We will see how loan losses, particularly in the commercial real estate, will hamper and offset these results. But near term, we're doing great. It's what happens when these margins start to compress, and we will see
and the
repeat.
pressure is on to make the same amount of money, but then you don't have those same margin, the comfortable margins that you had before. So, but the banks would argue that they are dialing back risk and that they are implementing better risk management, and they will say that, you know, look, there's regulation going on right now that's going to force us to anyway.
Well, and we need to be very realistic about what this regulation will and will not do. Perhaps there will be greater emphasis on absolute leverage that is reported to the markets. But those measures, as we have learned repeatedly throughout this crisis, are not reflective of the actual risk on those balance sheets. So you could have perfect leverage ratios and huge problems if these companies load up on securities that are not captured by that leverage.
So it almost argues then for staying long the big banks up 25% and effectively staying short the regional banks down 25%. Is that right? Does that spread widen?
It's very difficult to say, simply because we don't know how much they're exposed to the next problem. And the problem could be a rise in interest rates because of inflation fears. It could be commercial real estate. The problem is that based on accounting earnings results and based on standard financial disclosures, you just don't know what kind of risks are embedded in these institutions.
Okay, Leo, that was great. Thank you so much. We've run out of time. Leo Tillman, L&M Tillman and Company.